I want to turn now to the other strategy that's sort of been underperforming as well this year, and that's international. And it all started out so promising, guys. Europe and emerging markets outperformed the United States very early on. A lot of people called for that to happen. It did. But it all basically faded. Look at the charts so far. I'm just looking at EFA, Europe, Australia, Far East, only up 8% this year. This is basically the global benchmark for ex-United States, the rest of the world ex-United States. Emerging markets, which is almost 30%, Hong Kong and China, also underperforming. And there's the S&P 500 up 15%. So the U.S. is far outperforming. And guys, as you know, this has been happening for a decade. But this was supposed to be the year. What happened? This was the year for international investing. All the cards were aligned in the right direction, at least, and it hasn't happened. Either one of you, go ahead.
So maybe I'll jump in there, Mike, and then you can come on there. So, Bob, I think a couple things. I think one, the highest predicting factor for future performance of international stocks versus U.S. stocks is what the U.S. dollar does. And that period that you mentioned from basically 2002 all the way up until up until 2022. Actually, it's 2011 to 2022. The dollar was in a straight bull market. So you were going to lose in international equities no matter what you did. The dollar topped. The dollar topped last September. OK, so you really have to have an opinion on where the dollar is going. We personally think the dollar is heading down for various reasons. But I think the second thing that people need to make sure, don't confuse international equities with U.S. S&P. The S&P is over 60% growth. International equities are less than 40% growth. The comparable index here in the U.S. is large cap value. Large cap value is also just under 40%. If you look at that versus large cap value, it is outperforming year to date and on a trailing 12-month basis. So I think you need to make sure that the viewers know what they're looking for. You've mentioned plenty of times, Bob, the S&P for the first half of the year was 8 stocks that drove it completely, and they were all growth stocks.
Yeah. So, Mike, does this make sense to you? I mean, the dollar story certainly makes sense. I'm not sure about comparing the rest of the world to the U.S. value. I mean, it's true. One of the reasons I think you can cite why Europe has underperformed is, for example, the German stock market has far fewer growth stocks in it than the U.S. stock market. That's certainly true. I guess you could call them value-oriented. Does that account for a big reason why we're seeing the underperformance?
Well, I think absolutely. I mean, you think about it from a multiples perspective. Look at the S&P 500 10 years ago, first on a forward multiple basis on earnings versus today, the multiples have expanded 20%. You look at EFA, you look at emerging markets, they're basically the exact same. And what's also interesting is they're actually the exact same if you look at the equal weight S&P 500 index. So it's not just international. It comes back to those FANG plus stocks, right? You have this situation where the market continues to get led by mega cap names, primarily mega cap technology or tech-like names. And in that, the big difference in returns over this past decade has been multiple expansion. You've seen no multiple expansion anywhere outside of the mega cap indexes. And I think that is the primary reason behind this. And then, of course, it just feeds on itself. If you look at just flows of the marketplace, you see more and more flows continuing to go into U.S. stocks, U.S. ETFs, which leads to U.S. stocks, where very little money is going into the international marketplace. And then it kind of just creates itself. I'm not sure what the catalyst is there, other than to say that it has to start with those big names: Microsoft, Apple, Amazon, Tesla now, Google. Those names that are creating this multiple expansion for the broader S&P 500 because they make up such a large percentage of it. That's where the catalyst will have to be to see value come back, to see international come back, to see emerging come back.
The problem is, all three of us sort of grew up in the last 20, 30 years with research that indicated that long-term value tended to outperform growth, and long-term, small cap tended to outperform big caps. This is well-known research, goes back into the 1990s and even before, and yet it's been over a decade now where this has not really happened. So it's a little... something kind of has to give. Either there's been a paradigm shift of some kind. I mean, 10, 12 years, since 2010 essentially, is a long time. You know, you can't say, well, you have to wait for 25 years for something to work. 12 years is a long time, and yet still, growth outperforms value, large cap outperforms small cap.
Yeah, I think, if you look at
you do get, you do get, like, going back to the mid 70s, this is only, if it were to persist here, would be the 6th time that international would outperform the U.S. So they are long periods of in between. They're brief periods that usually are less than 4 years in duration when international does outperform. And again, that's what I go back with the U.S. dollar. That's the biggest predictor there. And right now, the U.S. dollar is 10% off its top. You look at, we are way ahead of the rest of the world in terms of fighting inflation. Our inflation numbers are lower than the rest of the world. Our interest rates are higher than the rest of the world. So what does that mean? That's a perfect setup where we're going to be cutting rates before the rest of the world. And that differential leads to a stronger dollar. And I would just reiterate, I don't mean to beat a dead horse, but you can't underappreciate the fact that it's just like here in the U.S., if I'm a value investor, then I know it's because I've got 40% growth in my strategies. But if I'm a growth investor, I better have strategies that have 60+% if I'm going to keep up with the other growth indices.
Yeah. Mike, did you want to say something?
Yeah, I mean, I just say, I graduated college in '99, and I've been in the markets pretty much since I graduated. And I would still note that I have benefited from being in small cap stocks, right? I mean, I think we lose sight of the fact, just going back to 2000, the small cap index, the S&P small cap index, has trounced the S&P 500 in that time frame. So in my investing life cycle, it's just getting harder and harder to remember that alpha that was delivered in that first part of that life cycle. And so I think to Kim's point,
and you're talking about the S&P. You're talking about the S&P small cap, the 600, right? Not the Russell 2000, because those are different indexes, right? To a certain extent.
They are very different indexes, yes. I think you have to. I like to look at the S&P, but as long as you keep it Russell to Russell or S&P to S&P, you get similar results over those full market cycles. But yeah, I think the point being to reiterate Kim's point is that they can last in long cycles, and when it turns, it can turn very, very quickly. So it's painful right now. That diversification is real, and it's hard to stay the course. But ultimately, I think the long-term data proves out the benefit of being value, being international, being small.
We're all heading towards retirement on the long-term data. That's, I think, the problem. I want to hit one other hot topic right now, Mike or Kim, you can weigh in too. Avoiding losses. This has sort of been a growth industry in the last year, in addition to buying protection here and selling stocks and going out and buying calls. Another hot ETF product are the buffered products. So they're slightly different. Those of you who don't know about it, they avoid losses up to a stated amount. And once you go through the floor, then it's sort of you follow the benchmark. BlackRock's iShares launched a couple new buffer products recently. Mike, can you explain how these work? And it's sort of the same idea, buying some kind of protection at this point.
Absolutely. I mean, buffer strategies, these types of strategies have been around for a long time outside of the ETF world, where you're providing a certain amount of protection to the first set of downside. That's why all these buffer ETFs have a name in it, right? Like the Power 9 or the Power 20, because that 9 refers to, we're going to protect you for the first 9% of losses. So you're not going to experience that loss on the S&P, but once you go through it, you're going to keep going through it. And obviously the growth, the timing of the launch of these in the ETF market couldn't have been better, right? Timing is everything in the ETF world. It came into kind of that first volatile marketplace that we've had in 10 years. We had a bear market, and these strategies delivered as long as you know how to use them. What I mean by that, Innovator ETFs does a really good job explaining it on their website, providing the right data. But you have to understand that once you go through that buffer, that cap, that loss protection, you're now going to start tracking whatever your reference index is one for one. And so you need to be active with this. And the good news is the data proves out that the investors are. If you look at the flows, we've gone from 0 to 20 billion. The money is going to the front month of the resets of these products.
Yeah. And Kim, the one thing, again, I noticed is money keeps pouring into these kinds of strategies. Even though we're in an up market, people seem to have this sense that the rally's very fragile. There's a lot of naysayers still out there, I think, and that's why these products still attract money.
Well, yeah, to that point, Bob, think about the strategists for Wall Street as a whole for the second half of the year. Their target price is negative 5% from from the end of the June quarter. So you are right. I would also point out that, as Mike said, you have to. I go back to the promise that you're supposed to make clients is that we're going to deliver this expectation for the strategy or product, and then you need to deliver on that. You need to deliver just on your expectation. It's very, very difficult for these buffers to actually deliver for the average investor because there's so much timing involved. And I just look quickly at First Trust's DDEC. So David, Edward, Charlie, that's their oldest ones. They've been out for almost 4 years. They don't tell you to buy and hold, but if you were to buy and hold it, you were up 4. The S&P was up 11% over that period. Not so good. How about for periods like 2021 when the tape was running and you were supposed to be capped at up 15%? You were up 8 and the S&P was up 29. Okay, how about 2021? You're supposed to be, or 2022, you're supposed to be down, like only 5 because you're protected on the down 5 to 30. Well, you were down 7. That's because there's a wrapper expense, there's some slippage. So again, it's really, really tough to deliver on the expectation, and those prospectuses are thick.
Yeah, and even these things, the Jack Bogle in me kind of gets all up about this, that you're still doing market timing of some kind, and Jack always wagged his tail. You can't do that successfully in the long run, guys. One of the precepts on which Jack lived for many, many years.